Let's talk now to Fiona Cincotta from City Index. Fiona, just how unprecedented is this disruption that we are seeing?
This is huge. I mean, if we have a look at an index which is called the volatility index, the VIX, which is considered to be the fear gauge for the US markets, that's risen to a level of 40, which is a level which is very much associated with the most turbulent of time. So, you know, this is something that we've seen. It feels very similar to what we saw in the COVID pandemic. We've heard you mention that several times. March 2020, the lockdown then. This is what the same sort of size of moves that we're saying, the same fear that's being seen. I mean, if we're just talking about the US tech stock, they've seen around 6 billion wiped off in $6 billion US dollars wiped off. It's down almost 20% from its record highs. So these are huge moves that we're seeing.
What, if anything, helps investors keep a cool head?
That's a very good question, you know, because there is this saying, don't try to catch a falling knife. So I think one of the errors may be trying to jump in too soon if you want to sort of try and buy in at low prices. I think that would be rather dangerous at this time. But I think the thing to remember is that stock markets do have a tendency of sorting themselves out. It might take a long time, but we have seen, even in the COVID pandemic, there was a recovery, and we've seen stocks rise to, you know, record highs earlier this year. So there is that sense that, you know, don't panic. Do keep in mind that things can recover, and also to balance your portfolio where possible, including exposure to bonds.
The risk of asking you a question that starts with how do you catch a falling knife, what is your outlook for global markets?
You know, I think the outlook is depressed right now, and I think it has it will likely remain depressed for the time being. Obviously, we're looking at this period now of slowing growth, potential recession. Also, at the same time that we could see inflation push higher, which opens this stagflationary outlook, which is very difficult for the Federal Reserve or other central banks to deal with, because it requires different policy measures to sort of support the inflationary aspect or the growth aspect, and cut the inflationary aspect. So I think, you know, we are looking at a depressed outlook. I think we'd either need to see a walk back from Trump and some serious negotiations going on with other countries which sort of lower these tariffs, or the Federal Reserve jumping in and cutting interest rates by more than expected. That could also help support sentiment, but neither of those seem to be happening right now.
As you suggested, the US Secretary of State today dismissing the market's concerns, saying the markets will adjust. He might be right.
I think the markets, they will adjust. I mean, that's the, you know, what we would expect to happen. There will be a bottom, there will be a turnaround, and the markets do eventually get to grips with what's happening and start repricing. The problem is, as well, when there are big surprises and big shocks, we know the market doesn't like that. And obviously these trade tariffs were larger than what we were expecting. The retaliation from China has been strong, and there's potential further retaliation to come. So I think, you know, we're seeing shocks. There is potential for more uncertainty, and we know that the markets don't like that. So whilst there could be a bottom coming at some point, I don't think we're quite there yet.
Fiona, thanks for that. Fiona Cincotta from City Index in London.